Does parent income hurt college financial aid? Have you ever wondered how your income as a parent impacts your child's chances of receiving financial aid for college? This is a common concern for many families. Let's break down how parent income plays a role in financial aid eligibility. First off, parent income does indeed affect college financial aid eligibility. However, the impact can vary based on several factors. These include the type of aid being sought, the overall financial situation of the family, and how income and assets are reported. The free application for federal student aid, often referred to as FAFSA, uses parent income as a key element in calculating the student aid index. Colleges use this index to determine how much need-based aid a student qualifies for. Generally speaking, a higher parent income can lead to reduced eligibility for need-based aid. For instance, an increase of $10,000 in parent income might lower need-based aid eligibility by around $3,000. Keep in mind that this is a rough estimate, and the actual impact depends on the entire financial profile of the family. When it comes to assessing parent income, FAFSA looks at tax returns from 2 years prior to the academic year for which aid is requested. This means that the income reported is not from the current year, but from the past. This income is combined with other factors like family size and the number of family members attending college to calculate the expected family contribution. Now let's talk about assets. Parent assets usually have a smaller effect on aid eligibility compared to student assets. The formula expects parents to contribute only about 5.64% of their non-retirement assets. In contrast, students are expected to contribute up to 20% of their assets. Certain assets, like retirement accounts, are not counted. However, savings accounts, real estate investments, and college savings plans owned by parents can reduce aid eligibility. The way parents manage their investments can also influence financial aid outcomes. For example, holding investments in accounts that are protected from FAFSA calculations can help reduce the impact on aid eligibility. College savings plans owned by parents are counted as parental assets but only at the 5.64% rate, which is more favorable than student-owned assets. It is also important to consider how income generated from investments, such as dividends or capital gains, is included in parent income. This can further reduce aid eligibility. Families should think about the timing of income recognition or deferral as part of their aid planning. In practical terms, families can optimize their financial aid eligibility by maximizing assets that are sheltered from FAFSA calculations, managing the timing of investment income, and understanding the differences in asset treatment between parents and students. Consulting with financial advisors who are knowledgeable about investment strategies and financial aid rules can be beneficial. To sum it up, parent income does reduce eligibility for need-based financial aid. However, the extent of this reduction depends on various factors, including income level and asset types. Thoughtful planning around asset management and income reporting can help mitigate the negative impact on financial aid.